Hi friends, welcome back to Mufti Finance Academy. Today we will discuss one interesting player from auto ancillary space. Previously we have covered SJS, Lumax Industries, Lumax Technologies and other players. But today we will be discussing about Fiem Industries. So before we start, a quick disclaimer, I am not a SEBI registered analyst. The companies which we are going to discuss are purely for educational purpose only. Please do not consider it as a buy or sell recommendations. So Fiem Industries in Q3 fiscal year 2026 print delivered a triple digit style beat. Revenue grew 16.2%, EBITDA surged by 25.4%, and PAT jumped 33.8% year over year. Operationally, the company finally breached the 14.25% EBITDA margin threshold, signaling a structural breakout from its historical 12 to 13% range. The real question for the Dalal Street is, can Fiem successfully break its two-wheeler concentration to win the high-stakes passenger vehicle lighting game without diluting its industry-leading capital efficiency? Fiem is the cleanest equity proxy for the India's two-wheeler premiumization story. While its primary listed competitor like Lumax Industries carries a premium for its four-wheeler mix, Fiem has dominated a specialized niche with over 97% of revenue tethered to two-wheelers. So this concentration isn't a bug. It's a feature of a business that has mastered the high volume, high precision requirements of the transition from halogen to LED. The narrative, however, is approaching its Mercedes moment. The market has long valued Fiem as a tier 1 two-wheeler vehicle ancillary, but the company is currently leveraging its pristine balance sheet to leapfrog into the global luxury four-wheeler supply chain. We are witnessing the pivot from a specialized manufacturer to a diversified electronics powerhouse. So the company founded in 1989 as Rahul Auto by first generation entrepreneur Mr. J.K. Jain. PM has evolved from a small Delhi based lamp maker into a vertically integrated lighting titan. The company's trajectory changed permanently in 1998 with the introduction of multifocal reflectors in India, establishing a pattern of technological first mover advantages. So the company is having 9 manufacturing units across India, 3 global R&D centers, one in India, Italy, and Japan, employing over 120 personnel. Its key products are headlamps, tail lamps, blinker lamps, fog lamps, rear view mirrors, and plastic molded parts. Coming to its revenue mix for Q3 fiscal year 2026, automotive LED lighting is around 47.53%, conventional lighting is around 27.76%, rear view mirrors is at around 10.84%, and plastic molded parts is at around 9.29%, and niche electronics like bank angle sensors. So FIEM's moat is built on being the first to introduce LED lights in Indian two-wheelers. This has transitioned into a commanding first mover advantage in the EV OEM space, where FIEM nearly supplies every major player, including Ola, Ather, and Torque, with an in-house NABL accredited photometry lab. FIEM provides OEMs with the shortest development to market timelines in the industry. So the market still views FIEM through the lens of a lamp maker, but the internal architecture is being revised. The value driver has shifted from plastic housing to electronics integration, the SMT or EMS guts of the lighting system. So the investment thesis follows a clear ladder. Secular volume growth in two-wheelers acts as the flooring, production up 15% in this quarter, while the premiumization mix conventional to LED acts as an accelerator. So this expands margins 14.25% achieved and generates massive cash flow, which is nearly around 222 crores cash on hand, which is then reinvested into high alpha technologies like adaptive drive beam ADB, matrix lighting, and laser systems. So what the market is missing is there is a structural margin kicker developing from FIEM's in-house SMT and EMS capabilities. By utilizing its new Gurugram EMC/EMI lab for validation, FIEM is capturing value that peers typically outsource, ensuring that the 14% plus margin floor is a product of technical efficiency, not just raw material cycles. The macro environment is also exceptionally constructive, with India's fiscal year 2026 GDP growth estimated at 7.4%. This resilience in discretionary spend is flowing directly into the two-wheeler sector, which saw a production hit 6.8 million units in Q3, which is up by 15% year on year. The industry is now on a clear path to cross the previous fiscal year 2019 peak of 24.5 million units. Its regulatory tailwinds, specifically GST rationalization and government's green manufacturing push, align with PM's internal transition. The company is currently rolling out renewable energy projects across all plants to drive down power costs and improve its ESG profile for global RFQs. So, coming to its revenue mix, for automotive lighting, which contributes nearly 47.53% of Q3 revenue, the undisputed engine of current margin expansion. It's conventional lighting, which is around 27.76%, the legacy cash cow that provides its overhead absorption and scale. Coming to its rear view mirror segment, it contributes nearly 10.84% of the total revenue, which is a consistent 10% volume contributor via six state of the art in house plants. And 9.29% of revenue comes from plastic molded parts, which is critical for vertical integration, supported by 450 plus injection molding machines. So, if you see from two-wheeler segment alone, it generates nearly 97% of the sales, the bedrock of the company's current valuation. So, from four-wheeler segment, the company generally generates nearly 2.98% of the sales. This is the growth option currently supplying Mahindra and Mahindra. And the bank angle sensors, it is a niche technical sensor supplied to Honda and Yamaha under TA with Toyo Denso. So the next is IPIS and LED luminaires, which is contributes nearly 0.23%, which is a non-core railway and bus information systems. So the earnings quality in the Q3 print is pristine, devoid of the accounting gymnastics often seen in mid-cap ancillaries. So revenue grew 16.2% year on year. So the friction is the HMSI Honda relationship. While HMSI production grew 18%, Fiem sales grew 14%. This is model mix specific. Fiem currently lacks presence in the high volume, highness model headlamp assembly. Coming to margins, EBITDA hit 14.25%, driven by operating leverage and efficiency drives. This is not a one-off. Management has signaled 14% plus is the new structural floor. Coming to balance sheet, it is a fortress structure with 222 crores cash with zero debt and healthy OCF to EBITDA conversion. Coming to capex, 100 crores earmarked for fiscal year 2026 with a total 200 crores 2-year roadmap for capacity expansion and PV development. So Fiem is in a rare sweet spot for a manufacturer. It generates more cash than it needs for its two-wheeler business, using that surplus to fund four-wheeler tech labs without borrowing a single rupee. The margin expansion is coming from internal efficiency, not just lucky raw material pricing. Coming to some con call highlights, management maintains a conservative yet consistent tone, preferring to under promise and over deliver. So the company is continuing to invest in innovation, including laser system, touch interface, adaptive drive beam, and matrix lighting. So here Fiem is no longer building simple lamps; they are building complex computer-controlled lighting guts. So the company's EBITDA has crossed 14% for the first time. So management here is confidently re-rating the company's profitability floor, and the company's plant and other things stand approved as potential supplier to Mercedes globally for small lamps. So this shows the ultimate quality audit passed. While orders are 18 to 24 months away, Germany has signaled Fiem's tech is world class. So the company is also in the process of building its credibility first, entering into small lamps for four-wheelers. This shows a land and expand strategy. They start with fog lamps to build trust before bidding for high-value headlamp assemblies. Its Rai plant fire incidents happened because of short circuit. So here management is transparently disclosing about this incident, and but investors must watch the recurring nature of these incidents. Coming to its mass production for TVS Norton which will start in a couple of months, supplies to Norton, UK, and TVSM India. So here this validates Fiem's ability to handle premium global standard exports. So the company also received a mail of RFQ also from customer for on ambient lighting. It is moving in the right direction. So here real-time evidence that the electronics integration thesis is actively converting into new revenue streams. So despite safety audits, the recurring fire incidents at Unit 7 Rai and Unit 8 Tapukura suggest systematic gaps. The Jan 30 insurance filing of 82.3 crores for Unit 8 is significant, though policies are on a reinstatement basis, mitigating balance sheet impact. So the leadership is technically sound and fiscally disciplined. Winning a global approval from Mercedes proves their engineering is elite. However, the recurring factory fires are a nagging operational risk that suggests safety culture needs to catch up with their tech. The company's capacity utilization is at around 77 to 78%. So there is enough headroom to absorb the fiscal year 2027 demand surge without immediate massive brownfield spend. The company's 9-month sales growth is also at 15.54%, comfortably within the 15 to 20% guidance range. And its net sales CAGR is around 11.97% over 5 years, highlighting steady non-cyclical compounding. So coming to its valuation, Fiem currently trades at a tier 1 two-wheeler ancillary. So it successfully pivots to the four-wheeler supply chain. The current ancillary multiple is the wrong yardstick. In a bear case scenario, if 2 gigawatt demand stalls, passenger vehicle gestation exceeds 24 months, insurance claims for fares face heavy haircuts. So in this case, we could see a derating. In a base case scenario, if there is a 15% growth and 14% margins, steady share at Honda Motors and TVS. So here this can be a base case scenario. In a bull case scenario, if Mercedes RFQ converts into high volume global supply, matrix and laser lighting adoption pushes margins to 16%, then passenger revenue also shares also hits more than 7% by fiscal year 2028. So here we can say that the stock isn't cheap based on historical PE, but it is fair given the structural margin breakout. You are essentially getting the two-wheeler compounder at a market value and receiving the Mercedes or Mahindra four-wheeler growth as a free call option. So what are some of the risks in this company which I observed are customer concentration. 60% of revenue is tied to TVS and Honda Motors. Fiem is at the mercy of their specific model success. Example, the highness front lighting gap and operational safety. Two major fires in 2 years suggest systemic risks that insurance cannot fully cover due to business interruption. And PV gestation risk. The four-wheeler world moves slowly. Return on investment for players like Mercedes or M&M takes 18 to 24 months from RFQ to production. And the last risk is reinstatement basis risk. While insured, the time lag in claim assessment for the 82.3 crores Unit 8 claim could strain working capital if multiple incidents occur. So what are some key monitorables are RAI insurance settlement, Unit 8 fire claim, HMSI wallet share, M&M development, TVS Norton commencement of mass production for UK and India exports, Mercedes Germany's RFQs, Yamaha Tracer 700, which is an export volume stability to Europe, and ambient lighting, transition of current request RFQs from proof of concept to firm orders, and renewable energy ROI, evidence of power cost savings in the next 2 to 3 quarters. So, Fiem Industries is no longer just a lamp market, it is an electronics integrator. The Q3 results prove that the margin expansion is structural, supported by a fortress balance sheet and zero debt. While the two-wheeler segment remains the cash-generating bedrock, the path to four-wheeler diversification is clearly laid out with global endorsements from Mercedes. Executions on margins is a proven commodity. Execution on the passenger vehicle pivot remains the final frontier. At the current valuation, investors are buying a high-quality two-wheeler compounder with a significant unpriced upside in the global luxury four-wheeler supply chain. If you like this video, please do like, share, and subscribe to Murthy Finance Academy. Thank you.